Let me tell you about my latest research. It's called Alice's Adventures in Factorland: 3 Blunders That Plague Factor Investing. It's co-authored with Rob, Vitali, and Juhani. And let me motivate the paper. And actually, it's pretty easy to motivate. That the people and institutions that have pursued factor investing have been very disappointed by the outcome, especially over the last 15 years. That's the problem, and our paper basically explores why. So we focus on 3 main issues. So mistake number 1 is expectations of expected returns from these factors that are grossly exaggerated. So why are they exaggerated? People look at the backtest results. I've documented in my own research that over 400 factors have been proposed and published in top journals alone. There's a massive amount of data mining going on. And when you've got data mining, things will appear to work when they're not really working. So it's no surprise with a very good back-tested return that you develop an expectation of a future return that's exaggerated. Okay, so that's kind of the first thing. The second thing is that as more people pile into these factors, prices are driven up and expected returns are driven down. And this is a typical result of what's known as crowding. The third problem within this exaggerated expectations is the naive assumptions that go on for the transactions costs that are involved in investing in these factors. Indeed, the academic literature, it's routine to assume that transactions costs are 0. And that's just plain not representing the real world. For example, the cost of short selling a small cap or micro cap is enormous. And often it's assumed to be 0. So that's what we call the first blunder. The second blunder has to do with naive risk management assumptions. It is essentially the case that many people believe that these factor returns, their portfolios, right, of long and short, are essentially normally distributed. Well, they aren't. They're not even close to normally distributed. When you do a long-short portfolio, who knows what you're actually going to get? So our paper actually explores the distributional characteristics of these factors, and they have got very substantial tails. Those tails need to be taken into account, and routinely, they're not. We have an example in the paper of a momentum strategy, a cross-sectional momentum strategy. And we showed the difference between the realized strategy and a strategy where we kind of hardwire a normal distribution. The drawdowns are dramatically different. So the second problem, again, is naive risk management assumptions. The third problem is also very serious, where an investor might say, well, yes, I understand that maybe there's some non-normality, and maybe I understand that there's some data mining going on, but I'm okay because I've got a portfolio of factors. So I'm diversified. Well, we show in this paper that that is a false assumption. Indeed, there's some reason to believe for certain variables, if you add them together into a portfolio, the portfolio is better behaved in terms of tails. That's not the case with the portfolio of factors. And we look at a number of different portfolio of factors, and they have very substantial drawdowns that you would not expect from a normal distribution. Indeed, when you really need the diversification in a crisis-like situation, that's exactly the time where the diversification vanishes. So these are 3 important mistakes that individual investors, institutional investors, routinely make. The last part of the paper actually looks at the performance of the leading factors over the last 15 years and asks the following question. So given the portfolio performance over the last 15 years, and given that we've got a long history of back-tested returns to the early 1960s, how likely is it to observe the poor performance that we've seen over the last 15 years? What we are addressing is the question, is factor investing broken? So we propose a bootstrapping technique to actually figure out the probability of drawing a 15-year sample like we've seen over the last 15 years. And that probability is very small. The conclusions of our paper are the following. If you're going to pursue factor investing, you need to understand the inputs. You need to understand the process. You need to understand the limitations. You need to develop reasonable expectations of what you will get factor by factor and portfolio by portfolio. This is a very difficult business. And if you start off constructing your portfolio with naive assumptions, then you're asking for trouble. We provide some guidelines and some new research that hopefully will lead to portfolios that closely match expectations.